If we're seeing unemployment rates start to move higher, those are signs the labor market's cracking. That might mean the Fed has to cut a little bit more, but I say be careful what you wish for.
Markets can feel overwhelming, endless headlines, recession fears, volatility, and noise that can drain confidence and joy from investing. But what if this moment isn't about bracing for impact? What if it's about learning how to ride the wave? Today on the Midland Money Mindset, we welcome back Ryan Detrick, Chief Market Strategist at Carson Group and one of the most trusted voices in market research. Ryan joins us to break down his 2026 market outlook, riding the wave, sharing how fiscal policy, interest rates, global growth, and the AI revolution may shape the year ahead, and how investors can stay grounded, optimistic, and empowered through it all. I'm Larry Sprung, your host for the Midland Money Mindset and founder and wealth advisor of Midland Financial. Let's dive into the show. Well, I am super excited today to have Ryan Detrick, Chief Market Strategist at Carson Group, with us today to talk about the 2026 market outlook. We're taking a little bit of a different take. We're going to have Ryan on a regular basis to talk about the markets, the economy, and what they see going on. So welcome to the show, Ryan.
Now, Larry, thank you for having me back. It'll be fun talking about what we see this year, and I'm even more excited to join you more frequently as all the crazy stuff that you know is going to be out there and you know is going to happen to come on and talk a little bit more frequently. So thank you for that.
And for those of you listening, if you want to access the full market outlook, you can go to midland.us/2026 outlook. So everything we're talking about today can be found in detail there. Let's kick this off, Ryan. I want to talk a little bit about the title of the 2026 market outlook. You called it Riding the Wave.
Yeah.
Let's talk about that. What wave do you believe investors need to understand right now, and why does it matter more than the fear they may be reading in the headlines?
Yeah, when you write an outlook, it's, thousands and thousands of words and 25 different charts and tables. But you want to have a theme. You want to have a major theme that pulls it together. And I think it was Barry Gilbert on our team that said, how about ride the wave? And it's like, as soon as we heard it, we all like, oh yeah, that's it. That's good. Something simple to the point. You ever riding the wave? You ever surfed, by the way, Larry? You ever done that?
I have not. I'm only a frozen water guy, not a liquid water guy.
Well, I've never surfed either, but you think about it, it's exciting. There's a lot of momentum behind you. It takes you where you want to go. You don't really have to work necessarily all that hard, but sometimes waves can do funny things and then you can kind of crash and burn, So that's kind of the imagery we wanted with this. Now, for us, as I know I've come on to you before, the Carson Investor Research team took the road less traveled 3 years ago right now, all right, when our team started. And we said there'd be no recession and stocks would do well. Well, we were mocked, we were belittled most of 23 and 24 for being pretty optimistic. We're still optimistic 25. Fast forward to right now, we still think, Larry, there's reasons I think this bull market, yes, it's older. Just because it's old doesn't mean it has to end. Now, make it real quick here, and then we can get into the weeds of it. There are certain momentum things behind us, right? There are things like fiscal policy. That's like tax cuts and deregulation. Monetary policy, that's the Fed likely cutting interest rates later this year. We have AI right in the middle of earnings season. AI, CapEx spending is not slowing down. That's another potential major driver. Oh, by the way, record earnings, record profit margins, global economy is getting stronger, specifically in developed international and emerging markets. These are all tailwinds. Now, there are risks. We can get into that. There are always potential issues. But to wrap it up, we've come out with a potential target on the S&P 500 this year, or between 12 and 15%, which would be a better than average year. And everything that is listed, we think it will be, when all is said and done, a better than average year for investors in the fourth year in a row of some pretty darn good gains.
Yeah. And just to timestamp this, we're recording this on February 3rd. So, and we're going to be putting this out right away. So there's not going to be a big lag between us having the conversation today and it getting out to our listeners. One of the things that I think a lot of people are somewhat anxious about, right, is recession, the R word. Mm-hmm. And you talked about that in the outlook, and you acknowledged that there's slower growth, but you're not seeing the R word, recession. What are investors missing when they focus on slowdown instead of resilience?
Yeah, great one there. So Sonu Varghese on our team, Sonu well. He does a lot of incredible, we call it macro work, like top down. How's everything really doing? And then it filters down. He continues to say things are solid. I mean, the consumer, right? I mean, here's one way to put this. Just recently, like a couple weeks ago, all right, we saw consumer confidence, the lowest level in like 12, or actually, yeah, in 12 years, 2014. So people are like feeling worse now than they did during a 100-year pandemic. But Larry, we see data like consumption, like retail sales, how many people are going through TSA, how many people are going to restaurants, all that stuff. Yet people are still spending money. So it's this soft data versus hard data. And we can talk for an hour on why people feel certain ways. I do think there are some issues with the labor market we get into. If you're younger, it has been harder to get a job. And inflation. Inflation is still stubbornly around 3% year over year, meaning prices are still going up about 3%. They're not going up the 9% year over year we were seeing back in 2022. So, and in politics do play a part of this too. When you smush all that together, I think people don't feel very good, but yet the market is a forward-looking mechanism. It's pricing those things in. It's all about corporate profits and some of those other things we talked about. So I think that's one of the reasons. And then just again, to wrap this up, we have something called the Carson Investment Research Leading Economic Indicators, LEIs. Our LEI was saying back in 2023, there'd be no recession and we would have a pretty good year of growth. Well, we had a really good year in 23. Everybody else's LEIs were saying not such great stuff. Why is that? Well, there's like 40 components to it. Sonu can explain that at a different time. I'm enough to be dangerous here. I know we have a lot of hard data. What's really happening? What's industrial production doing? What are earnings doing? What's retail sales doing? A lot of other LAIs have soft data. How do you feel? What do you feel? Now, we incorporate that. Yes. We've been saying for 3 years now, we're going to focus more on the hard data. And the reality is the hard data, Larry, is still quite solid in our opinion.
Yeah. So we're seeing this wave that we're riding right now from the last couple of years. Recession doesn't look like it's in our foreseeable future. I think something that people are seeing and feeling right now is the labor market, which you mentioned earlier, right? Hiring has cooled off. We're seeing some more layoffs, but I think relatively speaking, they're remaining somewhat historically low. What's the one labor market signal that would actually make you, maybe pause or change your outlook about what you're seeing going on?
Absolutely. I guess it'd be plain and simple, the unemployment rate, right? If the unemployment rate's around 4% now, if it were to really start to spike higher, that would be a potential worry. Sonu doesn't anticipate that. I'm not anticipating that. Larry, we just saw 7 months in a row where the monthly jobs number, non-farm payrolls, were higher, lower, higher, lower, higher, lower. 7 months in a row, it alternated. Okay, that's not a solid labor market. I'm not saying anything we don't know. We have obviously issues with immigration. We had obviously back in April of last year, Liberation Day, and all the uncertainty and the promises of no food on shelves, no nothing on the shelves. Everyone's going to be unemployed. Inflation's going to soar. Well, fortunately, none of that happened. We are seeing some baby steps, though, that we had 2 months in a row of positive job growth. Unemployment rate went down a little bit lately. We've seen small businesses are starting to tick up in their hires a little bit. So we're seeing some baby steps that the labor market is trying to improve. And that's one of our expectations this year. If we're seeing unemployment rates start to move higher, those are signs the labor market's cracking. That might go down the domino here. Might mean the Fed has to cut a little bit more, but I say be careful what you wish for. If the Fed has to cut a whole bunch, it probably means the economy's not very good. Right. Maybe they should cut a couple times this year with the labor market coming back. That's our base case here.
Yeah. So, I mean, it seems like the headlines that we've been hearing recently, like Amazon, 16,000 workers, are not really impactful based upon what's really happening from a numerical standpoint, I guess.
Yeah, great point. I'll dive in there. That's a great point. First off, you're talking to someone who's been laid off and fired. So I get it, okay? I've been on all the sides of these things in my incredible 26 career in this industry. But the reality is this, and we talked about this on our podcast, Facts versus Feelings. So when I talked about this a lot, saying, listen, January is when you're going to hear high-profile restructurings, right? These are restructurings. These aren't companies like Amazon. I'm not saying, hey, we're firing everybody because people aren't buying stuff anymore. That is not at all what they're saying. And that's what most of these big companies. The truth, again, who grew the most, back in 22 and 23? It was the AI plays. It was these really going to AI yet. It was more the technology, these giants, these Mag 7 names. And the reality, again, now they just trim the fat a little bit early in the year. One more thing. If you have a job, you're in good shape. And that is the honest truth. But this, like you said, Larry, a couple minutes ago, this is a low hiring, but really low firing. Because again, people might get laid off. and they do find a job fairly easily. Like here, knock on wood, keep that going because we're not seeing spikes in initial jobless claims. And again, put a bow on this. January is when you see the large restructurings. It's unfortunate. I have been there. Probably most listeners have been there. But the reality is that's corporate America getting a little bit leaner. You have higher profit margins. There are the stock market's a very cold instrument. Let's be very, very clear. April of 2020, right? Some of the worst headlines in our country's history. Yet the stock market gained over 12% because as terrible as COVID was, the stock market sniffed out real soon.
You talked about the Mag 7, right? And I think technology is something, and especially AI is something we can't really ignore at all. I mean, it's everywhere, and you compare today's AI investment boom to railroads and the internet. How can investors participate in AI without chasing it or over concentrating risk? Because I think, those who have a longer term investing profile, right, who remember the late 90s when the internet boom took place and they started out and 5% of their portfolio might have been allocated to technology and internet. And then overnight, 95% was. And when that came tumbling down, there was a lot of risk there. So how can investors really participate in this AI without chasing it and over concentrating their risks, so to speak?
Well, is this where I say you should get a financial advisor?
Sure.
Work with Larry, work with the Midland team. That's the easiest answer, I think. But for most investors, you're right. I mean, it's a good problem to have because if you've invested in some of these Mag 7 names the last 7 or 8 years, give or take, I mean, how have you done? I mean, you've done extremely well. And then you have an area like tech for the most part since late October has gone virtually nowhere for 3 months or so. But the market's up here. It's because things like industrials, things like materials, things like energy, they've all done really well. A lifeblood of a bull market is passing the baton, is what I like to say. We've been seeing that. That's really healthy. But the reality, again, is you can simply buy baskets of the S&P 500. I mean, there's a lot of technology. There's a lot of tech adjacent in there. I think the key concept being what you said, what's the saying I use a lot? The stock market's the only place things go on sale and everyone runs out of the store screaming. I love to use that one because literally a year ago right now, what were we being hit with? DeepSeek. Oh, yeah, I remember that. DeepSeek was the worry about this Chinese AI chatbot that was super cheap. It's going to just crush all the AI, going to crush investment. Those names, the big Mag 7 names we're talking about, Larry, they all were down like 20 to 40% from late January to early April, Liberation Day. And then, yes, they all soared back. So let's just remember, when it's way up here and everybody loves it, your neighbors tell you how rich they are and everybody's excited, that's not the time to go all in, right? I mean, I love working with clients. I know you obviously do because you've built an incredible company doing this. The financial advisor's job, and a lot of time my job, is to help you from yourself because you're going to love it up here. You're going to hate it down here. Plans are useless. Planning is everything. President Eisenhower, this is a midterm year. They tend to be a little more volatile. Just read the headlines. There's going to be volatility. I think, Larry, at some point this year, we'll have a 10 to 15% peak to trough correction. That's going to hurt when it happens. But if you're planning for it, because it happens most years, that's just how this works, then you can buy some solid companies that, maybe you missed them on the way up, but they're going to come back to you. But you're not going to want to buy them when it happens, because I'm telling you, everybody on TV is how bad it is. Market's down. You say, oh my goodness, it's terrible. That's where, again, having that plan in place to buy some solid companies on the quote unquote cheap or cheaper is the way to go.
Yeah. Listen, I'll share, and I've shared this publicly. My son last year during Liberation Day, we were sitting on the couch over the weekend, or I don't remember exactly what the circumstances were, but he looked at me, he goes, listen, he goes, Dad, all these things are down. I didn't make my Roth contribution for this year. Should I do that now and buy? I was like, there's no better time than now. I don't know, if nothing else, it may not be the bottom, but you're not buying at the top. And to this day, he now charts back his portfolio back to Liberation Day because he's had a huge return on that investment. So, that's a real life example of what you just talked about.
I mean, that's awesome. I mean, just to remember, it's like, oh, Liberation Day. Oh, yeah, I kind of remember that. No, the stock market went down 10.5% in 2 days. It was down 20% peak to trough. We were worried about inflation, worried about a massive trade war. Everybody on TV is telling us there's a recession coming. The stock market's in a bear market, down 20%. Those tech names I mentioned down even more. Small caps down even more. It's easy to say, oh, yeah, I kind of remember that. No, listen, this is why when we do this stuff, I like to look at history. History doesn't repeat itself, but it often rhymes. Mark Twain. Larry, spoiler alert, we're going to have another Liberation Day type event somewhere in the future. You have a bear market about every 3 years, right? You have a 10% peak to trough correction on average once a year. You have a 5% mild correction 3 times a year. So it's going to be called something else next next time. But that's why I think it's so important to remember we're going to get through it. And great call by your son. People always ask me, like in April, what do you do? So, well, I put money in my 401k every 2 weeks, like I just did. I put money in my kids' 529s. You know what? When the market's down 10%, I have a rule. I put a little bit more money in my kids' 529 that month just because I have no idea where the lows are going to be. But I know if my son's in sixth grade last year, by the time we need that money, our future self is going to be thanking our present selves, how I've always explained that.
Yeah, absolutely. Let's pause for a moment. What actually brings you joy? It's something most people never think about, yet it shapes how your life unfolds. You're busy. You make responsible choices. You even plan ahead. But have you slowed down long enough to ask if what you're building supports a life you enjoy living? That's the reason I built my YouTube channel, to help you bring more joy to your money journey. Sure, we'll talk about all the essentials, but my real goal is to help you connect your finances with what brings you joy, because money is the tool that funds the moments that matter. If you want to explore that connection more deeply, visit my YouTube channel at Larry Sprung. One of the things we're talking about right now is volatility, right? We're talking a lot about that. And you talk about volatility as the cost of admission. And, one of the things that I think you mentioned kind of in passing a little bit ago was, you were expecting midterm year volatility and possible correction, right? So we talked a little bit about how investors should actually take advantage of that potentially, right? But how should investors mentally prepare for a pullback without letting the emotions sabotage their long-term results? Because I think we talk about this often, right?
Yeah.
We've all survived these downturns because we're still here. But at the end of the day, it seems like every time it happens, investors feel like it's something new. So how can they mentally prepare for what we think will be a pullback without letting that emotion get involved and hinder their long-term results?
Well, Larry, I usually talk about the Fed or the economy, but you're going down lanes I love to talk about, right? The psychology behind it. Now, actually, Bert White, our chief investment officer, I know Bert's been on your show before, he says volatility is the toll we pay to invest. I heard Bert say that probably 15 years ago, and I've kind of used it ever since too. Because again, if you want those massive gains, well, you have to accept the fact that it's not going to be a smooth ride at all. Now, there's a lot of ways to look at this. I mean, some of the best investors I've ever met when I travel the country and get to talk to people are people that just kept putting money in every 2 weeks and honestly didn't pay attention to any of it. I know that sounds crazy because we want you to pay attention to your money, but sometimes just having that plan in place, right? To be aware. I mean, that's why I think it's so important to look at history. Yes, every time is different. Every time is different. But what isn't is fear and greed. I don't care what you're talking about, money, you're talking about life, you're talking about politics, fear and greed truly drive so much of what we do. And I've seen it time and time again. You have too, Larry. When things are way up here, everybody loves it. When things are way down there, they hate it. I think working with a financial advisor or just really working with yourself, when you come into these years to understand there's probably going to be volatility. First, here's a couple stats. Midterm years, pull back 17.5% from peak to trough, okay? I mean, that's on average. That's by far the most out of the 4-year presidential cycle. Why is that? Listen, kind of year one, president, maybe things feel good. By year two, you realize, oh boy, here comes that midterm election. Don't shoot the messenger, everybody, but the party that's in the White House tends to lose seats. There's a little bit of uncertainty there. So you hit some rockiness, some waves. I mean, we have waves there. Now, I'll say this much, though. What's Sir John Templeton say? This time is different. The 4 most dangerous words. You ever hear someone say, this time is different, you should run the other way. But I will go down a little bit Sir John Templeton. This time is a little different because in 2018 and 2022, midterm year stocks were down. We had bear markets. They were not good for anyone. For the most part, most investors didn't do well in 18 and 22 midterm years. The Fed was hawkish back then, meaning they were hiking interest rates. They were trying to slow the economy down. That is not what we're seeing now. The old saying, Larry, don't fight the Fed. Just know when the Fed has cut interest rates near an all-time high, 22 times they've done it. They just did it in December, by the way. A year later, stock market higher 22 times. So just some fodder to think about. I think we'll be higher this time a year from now, by a good deal, maybe mid double digits, but we'll probably have that pullback. Just be aware of that. And I'll tell you, I do this for a living, you do this for a living. I don't care who you were. We're pretty bullish, right? We've been pretty optimistic. I don't care who you were. When the market crashed 10% in 2 days and all the stuff's going crazy and people are messaging me and hitting me up that I haven't heard from in 20 years, telling me how crazy everything is and how they want to get out. Those emotions, I don't care who you are, they're real, right? But it's why, again, you need a community, you need an advisor, you need like friends to talk about this stuff to help you from yourself a lot of times, not to make an irrational decision. Like your son, like you and your son sitting around, maybe you kind of felt, oh boy, this market is kind of squirrely. Are we going to a recession like everyone's telling me on TV? It's like, Dad, maybe this is a good deal. That's great. I love hearing that.
Yeah. And I think to use your riding the wave, analogy, right? If you're looking at the wave and you're on the water and that wave is coming and it's too big and you freak out, you're probably going to wipe out, right? But if you let it go and you calm down and you go through it, you'll probably end up on the other side unscathed. So I think
you sound like you know how to surf.
I don't, and I've seen it. I enjoy watching it. But hey, let's talk about global, opportunities now, because you're neutral on the U.S. versus international and more constructive abroad in 2026. In your view, what changed globally that makes diversification outside the U.S. more than just a theory now in 2026? Because that's a little bit of a shift that we've seen in the last couple of years.
That is, in 2023, 24, our team said, hey, the U.S. is the engine of growth. That's probably where you want to mainly be invested in. Trust me, we manage billions of dollars. We've always had some developed international, think Europe and Japan, Australia, emerging markets also. We've always had that, but just, a little bit underweight, not as much in a portfolio. Our big theme starting, I guess it would have been March or February of last year, Sony was doing some work saying, listen, the stuff that's going on in Europe, specifically Germany, some of the fiscal plans, the spending on defense, again, Sir John Templeton this time is different. We saw some things that said, you know what, some things are kicking off that maybe Europe is going to start to see more economic growth. That's exactly what happened last year relative to what was expected. And I look at like currency markets, right? The US dollar, I know it sounds crazy to say right now, but a year ago right now, at the end of January, early February, we were out there saying the dollar might be weaker. Now, Larry, I know the dollar's been weak the last year, and everyone's like, well, obviously, trust me, it wasn't so obvious. If it's obvious, it's obviously wrong, is what I like to say, because the reality, everybody thought President Trump's policies were going to lead to a stronger dollar. Well, if everyone's thinking alike, somebody isn't thinking, General Patton, we took the road less traveled. We might have a lower trending dollar. So we made moves in our portfolios, in the models we run for our Carson partners and their clients, to be aware that if the dollar goes lower, you know what happens? The rest of the globe tends to do well. That doesn't mean the U.S. is going to do poorly. We'll be very clear there. But the rest of the globe does better. And when we say we're even weight, U.S. relative to developed international, that is true. But I promise you, there's not many RIAs the size of us that are even weight developed international, because that's Europe, right? Europe has lagged for like 16 years. I mean, it was doing terrible. There was a survey at the start of last year, so January 2025, Goldman had a survey. They asked the same people in the room that they ask every year, what's going to be the top performing sector, area of the globe? It was like 60-something% U.S., the highest ever. Everybody said the same thing. The U.S. will lead last year. U.S. gained 19%, S&P 500 last year. Great year. Europe and emerging markets gained 30. Now, again, U.S. did a lot better than 2 years before. So I think, again, this is more of a global bull market. We are seeing resurgence in global economies. And again, I love to come back to earnings, wrap it up like this. We're in the middle of earnings season here in the U.S., not even middle. Yeah, middle of it. What are companies saying? Demand is still super strong, especially around the globe. 42% of revenue in the S&P 500 comes from outside the U.S. Right. If the rest of the globe's strong, like we think it will continue to be, that's still a net positive.
Yeah, I agree. So that's excellent. What do you have to say? Because I find that this is a common theme, right? After a couple of big years, we've had some nice size returns. We're calling for another 12 to 15%, as you mentioned, in 2026. What do you say to those investors that are like, oh, you know what? This has gone too far. We're at a top. This is going to come down. What do you have to say for them? Because there are those people that, that are seeing those huge returns and saying, this can't go up forever, which I think you agree to that. But, how's the expectation still 12 to 15%? How do we keep them focused in a way?
Yeah, a lot of thoughts in my head here. 2 years ago right now, early January 24, the S&P 500 broke out to new highs. We had that peak in early 2022, vicious 25% bear market, big rally in 23. Early 2024 made new highs. I was hearing the same conversation then. We've gone way too far, that we've had two good years. So not minimizing it, but I think the easiest way is, we know tech led so much of the market, right, in 2023, 2024. Last year, Larry, was the first year in 4 years where the 493, the other stuff, contributed more to the S&P 500's gains than technology. So I think having a diversified portfolio is the easiest way. And if you think the U.S. is a little stretched, I'm not disagreeing. I mean, I think it'll keep going, like we've said, but it is a little stretch. There are other areas around the globe. I mean, if you want to buy something cheap, Europe and emerging markets are still cheap. Now, they had a great year last year. Our base case, that's not just a one-off. We think those areas will continue. And listen, this is why we have bonds in portfolios. We have had a little bit of gold in our models. We have some managed futures. There's different things you can do to stay diversified, to help you sleep at night when stocks inevitably have those scary moments. The other stuff in your portfolio is supposed to help you sleep at night. And I think that's one way to get there. Now, one more little just way to look at this. This bull market is in its fourth year, right? Again, it started October 2022, so just had its third birthday. So it's in its fourth year. Larry, we went back 50 years. We found 5 bull markets that made it to right now, into the fourth year. All right. So I say a bull market's like a cruise ship. Once it gets moving, it keeps moving. It's hard to slow down, hard to stop, really hard to turn around. That's a cruise ship, kind of like a bull market, because here's where we're going with this. Those 5 other ones that made it to this point, an average length of those bull markets of 8 years. The shortest was 5. We had 2 go double digits. No, we're not calling for, I'm not going to complain. We're not calling for a double digit bull market, but I am just saying this bull market might not be as old as you think. And one more thing, we talked about this literally in our outlook the last 2 years. Third years of bull markets tend to be choppy, tend to be frustrating. Why is that? Because years 1 and 2 are usually off to the races. Well, what happened last year? Yeah, that was frustrating. That was choppy. That what we saw around Liberation Day was actually quite normal, to catch your breath, refresh the fear. That's what happened. And now we're in the fourth year bull markets, which tend to be pretty solid overall. And I know early we did just want to hit on this. Midterm years aren't usually that great. And that is true. That is absolutely true. They tend to be more volatile, but we still see more reasons, again, like I said, that we might have some midterm year volatility. But then when we look up, we're still going to have a pretty darn good year. And that's how we see things potentially playing out in 2026.
Well, maybe we're riding the wave for another 3 or 4 years. We'll have to see how that goes. You know, I think you bring up a good point, though, right? In terms of when people talk about market expectations and markets, I think their minds, investors' minds, immediately go to equities, and they're constantly thinking about that and not thinking about other asset classes. And I want to hone in on one in particular, because I think, you know, the next largest asset class that people think about is bonds. And when you put out the outlook, you're suggesting that this year bonds may behave closer to cash, but they still matter. You know, how should investors rethink their fixed income allocation after the pain of recent years? How is that different?
Great question there. So, historically, we say bonds zig when stocks zag. I'm going to talk broadly for a second. A 60-40 portfolio, 60% stocks, 40% other stuff. That other stuff used to be pretty much bonds. Now, again, when interest rates go up, bond prices don't do as well. 2022 bonds had their worst year since George Washington was president, and the stock market was down. So 22 was like one of the worst years ever for investors. 2008, stock market down 40%. It was terrible. I get it. But bonds got 15%. I'm not saying it made up for it, but it did help. And so what we've seen lately is something we've talked about, our shop. Listen, we think we're in a little bit higher inflation regime, maybe 3% inflation versus the Fed's 2% inflation. That's not bad. I want to be very clear. We don't think that's bad. Long-term history, stock market or inflation been 3.5%. It's just when inflation's soaring higher. We think inflation is going to hang out around 3%. So we've constructed our portfolios to have a little bit more of a higher inflation, higher growth world. And that is absolutely one of the best ways to beat inflation long-term is own stocks. I mean, that's plain and simple. I know it's like, talk in your book. Yes, because stocks historically have beaten inflation. So that's a good one. But we say also if you drop it and hit your foot and it hurts, maybe you want to own a little bit of that. We have had some gold and some metals and mining and some different things in some of the models we run. Not a lot. I want to be very clear. Not a lot, but a little bit that really, clearly in this environment has done really well. And I know gold's pulled back a lot. We still think commodities in general will probably do better as the global economy is still strong. So that other stuff, we say diversify your diversifiers. It used to be, again, just put me in some bonds, forget about it. We're not so sure about that anymore. And that's helped our performance, honestly, having some other stuff in there besides bonds. I want to be real quick on bonds. Bonds had their best year, Larry, last year since 2020. So stocks did great, globally did great. Gold, we know, did a lot. Silver did a lot. Commodities in general did well. But bonds had a darn good year. But again, we think bonds might gain about 3 to 5% this year. We think there's going to be a couple Fed cuts with new Fed chairperson coming in May, a couple Fed cuts later this year. But all in all, we think the economy is still going to be solid. So bonds absolutely have a place in a portfolio. But the way we're looking at it, we just still think stocks do a little bit better. And again, diversify buckets, how we're doing it with the money we run.
Yeah, sounds great. And diversification is so key to a portfolio. So listen, I want to wrap up. I appreciate your time. And I want to wrap up. This is the Midland Money Mindset. We're all about joy. So I'm going to forego the joy question because you were just on a few months ago and we asked you that. But okay. I want to leave investors with something here. If investors remember one mindset shift from your 2026 outlook, what would help them stay confident, disciplined, and even joyful no matter what the markets throw at them? What's that one thing?
Well, there's a lot going through my head right now. I love that question. Just know that every year has bad headlines. Every year has scary stuff going on. Every year is going to have volatility. You look at a long-term chart, the Dow Jones Industrial Average started trading on May 26th, 1896. 2 world wars, 2 100-year pandemics, inflation, deflation, Great Depression, assassination attempts, wars, all types of, I'm talking about bad stuff, unfortunately, but we're going to talk about good now. There have been a lot of good things that have happened also. It's not about timing the market. It's about time in the market. Just look at a long-term chart of the Dow, right? It tends to go higher over time. Back in 2022, we're in that bad bear market. Right when I started Carson, market goes straight down, go figure. But fortunately, it's been better since then. But we said then, I don't think this will be the first time in history where stocks don't eventually go back to new highs. Yes, sometimes you have to wait a while. But again, to buy some things on the cheap is the way to do it. Long-term investing, follow those plans, plan for some volatility, and just know that with the resiliency of the United States, with strong corporate profits, with those tailwinds we just discussed, we think a year from now, stocks are going to be a good deal higher. Might be rough getting there, Larry, but just to think about those concepts because those rough times eventually will come. But we're going to get over them just like we have every other time since 1896 when Charlie Dow started the Dow Jones Industrial Average. It had a bunch of railroads in it back then, not so much anymore.
Yeah, great takeaway for our listeners. And again, the full market outlook is at mitland.us/2026 outlook. Ryan, if people want to learn more about you, follow you, what's the easiest and the best place for them to do that?
Absolutely. I think Facts versus Feelings is our podcast. I do weekly with Sony. That's probably the easiest way. And then carsongroup.com/research is our blog. We write daily blogs. I write them. Sony writes them. Different members of our team. Actually, we're doing almost 2 blogs certain days. So lots of market content. carsongroup.com/research is our blog.
Well, that's great, Ryan, and thank you so much for your time. It's a pleasure working with you and having you as part of the Midland team. And we'll be doing this on a quarterly basis with market outlooks and market updates. So thank you again. And if again you want the full market outlook, riding the wave, mitland.us/2026 outlook. Thank you so much for your time, Ryan, and enjoy the rest of your day.
Thank you,
Ryan. Thank you for bringing clarity, perspective, and optimism to a conversation so many investors need right now. Your ability to balance data, history, and human behavior helps turn uncertainty into confidence and fear into opportunity. We're grateful for your insights, your honesty, and the joy you bring to the investing conversation. It's always a pleasure having you on the Midland Money Mindset. Ryan Detrick and everything he's up to can be found across most social media platforms. All the contact information needed to find them can be found in the show notes.